My name is Jeremy Graegin, Director of Advanced Planning for CBS Brokerage. Today I'll be discussing the topic of Graegin loans, which is part 2 of a 3-part series for federally taxable states that have closely held business interests and are liquid as to how to pay those taxes. The other video I did recently was on IRC section 6166. You can find that in our library, and I will soon do another video on trust-owned life insurance and compare and contrast the 3 options for paying estate taxes for liquid estates. So what makes a Graegin loan a Graegin loan? A Graegin loan is a loan from a third party, not the government, a third party that allows for the interest to be deductible against the gross estate on Form 706 of the estate tax return. It's allowed to be an interest deduction as a miscellaneous deduction under IRC section 2053, which is an administrative expense essentially. In order to, when you do that, when you deduct it against the gross estate, you reduce the the amount that's taxable on the Form 706. Therefore, you reduce the actual estate taxes. But there is an offset. You obviously paid that interest, so it's kind of like charitable giving, where you give $1 away to save 40 cents in taxes. You actually do incur overall more expenses, but it is deductible. Unlike the Section 6166 election, which the interest is not deductible. Now, to qualify for this type of loan, the loan must be necessary. I mean, you must have needed the liquidity that you took the loan for. Now, it doesn't have to pay for all the estate tax. It could pay a portion of it. Whatever was necessary could be deductible, assuming you got a loan from a third party. Could be a trust that you set up that was funded with life insurance. Could be, or other liquidity, or a bank, etc. Although getting a loan from a bank after your decedent had passed away may be problematic with a closely held business interest. The interest must be ascertainable and measurable, and must be assured to be paid. So if there's a prepayment option in the loan, it must assure that whatever the full interest amount that would have been paid over, let's say, a 10-year period would be paid regardless if it was paid up early. Again, that's because of the rule that the interest must be ascertainable as to the dollar amount in order to be deductible. The loan must be bona fide, meaning real. It must be documented and followed. So to the extent you enter into a transaction with family members or a trust, it's going to be more scrutinized by the IRS. Something like 33% of estate tax returns are audited versus gift tax returns, I think it's something like 1%. So it is something to take seriously. The lender must report the interest income. And finally, the authority to borrow must follow state laws. You take the deduction on Schedule J of the Form 706 under administrative expenses, under miscellaneous. Now you can imagine that the loan on and I'll show you a loan in this video. The loan amount could be large and the interest could be large. So it's going to be noticeable on this Form 706 when you put a multi-million-dollar miscellaneous expense, for example. When we model a Graegin loan, that's very simple. You're gonna have amount borrowed, you're gonna have an interest rate, term of years, principal, interest payments, combined payments. In this example, I'm using a $10 million loan, and there's $2,329,000 of interest. I want to show you what the net cost of a Graegin loan is. So, as I mentioned earlier, you've got the interest rate here, interest amount over that 10-year period that must be fixed. The federal estate tax rate of 40%. So the estate tax savings, if you took that deduction against the Form 706 against your gross estate, you would have saved $931,000, 40% of this amount in estate taxes. So you subtract that amount from the total amount of interest, and that would be your net cost of the Graegin loan. So this is how much out of pocket. So in other words, you can see there still was a cost. It was more than the tax savings. So you wouldn't do this simply for estate tax savings. So there are other options, obviously, besides the Graegin loan. IRC section 6166, as I mentioned in a prior video, and trust-owned life insurance oftentimes. The difference between this is that these are what affect cash flow after death, IRC section 6166, and loans, whether it's from a bank or a trust. And life insurance affects cash flow during a lifetime, obviously. And this is the demarcation line to the IRS. So the benefits of using of deferring paying the estate tax or taking loans and so forth is that you didn't impact cash flow during lifetime. although you have to worry about actually qualifying for either the 6166 or the Graegin loan, given the qualifications I had mentioned. And for life insurance, you basically have to qualify mortality-wise and financially. So I just really quickly want to compare the economics of life insurance against the Graegin loan. You could easily do the same with the 6166. And this, I showed a $10 million loan, so here I solved for a $10 million death benefit. The premiums on here are $181,651. Without getting into all the details about the insurance policy, it's a survivorship policy on 260-year-olds, assuming preferred rates. But the economics of that is what I really want to kind of go through right now, not product. So if you needed a $10 million, if you had a $10 million liability for estate tax purposes, for an example, and you had to fund that with life insurance, a 10 pay, meaning 10 payments and not paying it up, but essentially we're with under current assumptions being that to not have to add more premiums would be about $181,651. And under the loan amounts, having to pay that same amount, it would be $1,232,000 with loan, principal, and interest. At the conclusion of a 10-year period, that'd be $12,329,000 against $1,816,000 in insurance premiums. Now, obviously, there's a time difference as to when you would need it and so forth, and this dollar amount would change as you got older, maybe in the business grew. But it's just showing you this during lifetime, that at death. If you have any cases in the future you'd like to discuss, or federally estate taxes or business cases, please give us a call, look us up. You can email me directly or call me. Thank you so much for your time and watching this video.